Hello, my name is Samantha Grant, and welcome to Marquette Associates Investing 101 series on stocks. In today's video, we will cover what exactly is a stock, how stocks are generally categorized, and finally, the different ways you can invest in stocks. So let's jump right into it. What is a stock? A stock represents a share of ownership in a company. This share gives you as an investor the right to vote on the direction of the company, as well as an opportunity to collect capital gains through dividend payments and possible price appreciation. This is how it works. Let's say a US-based company decides they want to expand internationally. In order to fund an international expansion, the company issues stock. You as an investor believe expanding internationally is a good idea, so you give the company money in return for a share of stock or ownership in the company. If the international expansion is successful, your share of ownership may be rewarded with dividend payments and/or an increase in the value of the company. Does operating internationally mean this US-based stock is now categorized as a non-US stock? The answer is no. Stocks are usually categorized by market capitalization, also known as size, or how big the company is, and style, which can be based on a variety of measurements like price to book or forecasted growth. Amazon, a global retailer, is a $1 trillion company and would be classified as a large cap stock, while Abercrombie & Fitch, a $1 billion company, is classified as a small cap stock. Moving on to styles, a firm with high future growth in revenues like Amazon would be classified as a growth stock, while a firm with a significant asset base like JP Morgan would be classified as a value stock. This brings us to the 9-box style map, which is used to map stocks by their size, large, mid, and small, and style, value, core, and growth. Based on the information in the previous slide, Amazon would be categorized as a large cap growth stock. Categorizations also extend to non-U.S. stocks with the additional classifications of regions and countries. Developed markets represent industrialized and mature economies like the United Kingdom and Japan, while emerging markets represent industrializing, rapidly growing economies like China and India. These categorizations are key inputs into the development of an index. An index is a basket of stocks used to represent the market. For instance, the S&P 500 represents large cap stocks in the United States, while the MSCI EAFE represents large cap stocks outside of the United States. In this slide, we rank these stock categorizations by risk and return. You can see that stocks on the right-hand side in the blue have higher risk, but also higher returns than bonds, which are represented on the left-hand side in the gray. There are many more benefits to stocks than potentially higher returns. Stocks also give their owners voting rights, liquidity, meaning that you can buy and sell stocks fairly quickly and cheaply, and stocks offer investors transparent financial reporting. Some of the downside of owning stocks is that they carry higher risk. Stockholders are often the last to be paid in a bankruptcy, if they get paid at all. And finally, making money in stocks is not guaranteed. Next, we'll cover the ways you can invest in stocks. You can invest in stocks actively, meaning a professional investor will make buy and sell decisions with the intent of outperforming the market. This investor usually requires higher compensation for their skill. Or you can invest in stocks passively, where you pay a money manager to buy all of the stocks in an index at their index weight. Since this investor is just mimicking the index, the fee will be lower. You can access stocks through three main ways: mutual funds, commingled funds, and separate accounts. Mutual funds are the most expensive out of the three, but often have the lowest investment minimums. Commingled funds are similar to mutual funds, but are private, cheaper, and may be less liquid. Separate accounts infer that your investment is not combined with any other investors. As a result, unlike mutual funds and commingled funds, separate accounts are customizable. This concludes our Investing 101 webinar on stocks. I hope you found this primer informative. Please consider watching our other 101 webinars. Thank you for watching.